When most investors hear the word bubble, their minds jump straight to disaster. But history tells a more nuanced story. Some bubbles destroy wealth, others help build the future. The difference comes down to one simple question. What remains after the bubble bursts? Let's start with the dot-com bubble. Between 1995 and 2000, internet stocks went parabolic. Valuations detached from reality, money poured into companies with almost no revenue, and in some cases, no real business model. Then it popped. The NASDAQ crashed nearly 80% from peak to trough, erasing roughly $5 trillion in market value. At the time, many declared the internet had been massively overhyped. They were only half right. The prices were wrong, but the technology was right. The bubble funded fiber optic networks, data centers, software platforms, and e-commerce infrastructure. Out of the wreckage emerged Amazon, Google, and companies that helped reshape the global economy. The bubble burst, the innovation stayed. Now let's compare that to the housing bubble that triggered the 2008 financial crisis. That boom wasn't powered by breakthrough technology. It was driven by cheap debt, loose lending standards, and complex financial engineering. Home prices doubled in many markets, fueled by subprime mortgages and extreme leverage. When it collapsed, there was almost no productive infrastructure left behind. Just foreclosures, bank failures, a frozen credit market, and the worst recession since the Great Depression. One bubble created the future, the other borrowed from it. Which brings us to today's big question, artificial intelligence. Is AI in a bubble? Probably. Valuations look stretched in a lot of places. Plenty of companies will fail or disappear. But that's not the important question. The real question is whether today's massive spending, hundreds of billions into chips, data centers, power plants, and foundational models, will create lasting productivity gains in economic infrastructure just like the internet boom did. If it does, history may look back on this period the same way we now view the late 1990s. Painful for many investors, but transformational for society. The lesson is clear. The biggest investment opportunities often come from periods of excessive enthusiasm. The winners aren't usually the people who avoid every bubble. They're the ones who can tell the difference between speculation that builds something real and speculation that doesn't. Because in the long run, what matters isn't the bubble, it's what survives after it bursts. So what do you think? Is today's AI boom building something lasting? Or are we repeating the mistakes from the past? Feel free to leave a comment in the section below. If you're enjoying the Off the Charts series, please hit subscribe, turn on notifications, and next time we'll dig into another financial myth that most investors get wrong. I'm Jordan Dunsmore. Let's keep thinking clearly in a noisy market. See you in the next one.